Welcome everybody. I do want to first say I hope everybody's doing well, staying healthy and trying to stay as upbeat and positive as possible. And I really want to thank you guys for joining here today. This is a presentation I've done a number of times. We're going to talk a little bit today about technical analysis. And you know, we've kind of tailored this presentation towards market conditions. We're going to look at the markets first, because the market can do a few different things, right? And not every indicator is ideally suited for each type of market situation that you'll see. So it's a little bit of a unique presentation. I hope you guys enjoy it. My big promise to you is that by learning what I'll show you today, you'll see how that you can use technical indicators to help anticipate what's likely to happen in the future. You know, technical indicators aren't there to predict anything. That's not what we're about. You know, as a company, that's not how you should treat trading. You know, it's not about predicting, it's about anticipation, anticipating changes in trends, anticipating breakouts. You know, technical analysis indicators help us make better sense of price. It's really hard, if you just look at price, to understand it completely, what price is doing. That's what technical indicators are for, and that's what we're going to talk about today. You know, I've worked with a lot of traders over the years, and they've let me know some of the problems that they have when it comes to finding trades and just using technical indicators in general for trading. They feel like it's a crapshoot. You know, I've worked with a lot of our clients over the last couple of months, and they say, you know, with the market being so up and down and just the volatility is just nuts these days, they just feel like trading in stocks right now is just a crapshoot. They also tell me that they just don't know enough. They don't have the knowledge when it comes to trading, so they avoid it. They say you know, Jerry, there's just too many technical indicators. They got all these funky names. There's too many lines for each indicator, right? It's a little difficult to understand which indicator to use. So they just say, you know what? I'm going to stick with what I know, what I've been good at, and that's fundamental valuation, kind of buy and hold, position trading. You know, retirement-minded methodology. Plus, if they do decide to do it, they spend all of their time looking at charts. You know, I've had some of our clients tell me they look through hundreds of charts in a day just to try to find a handful of candidates, and sometimes they don't find any. You can imagine if you keep doing that for too long, just going to leave you really, really frustrated. You're going to give up. Again, you're not going to want to swing trade anymore. You're not going to want to study technical analysis because it's just so time consuming. What we want to do is we want to put probability on our side. You don't want it to be a crapshoot anymore. You want to stack the deck in your favor. You want to know what you're doing. While you might not know everything about everything, you know, there's dozens and dozens and dozens of technical analysis indicators out there. You don't need to learn them all. You'll know exactly what you need to know to be successful. Plus, here's the big part. You want to find your trades quickly instead of looking at hundreds and hundreds of charts. Now, the thing that I've discovered over the years, I've been with VectorVest now going on 15 years, I think, 14 or 15 years. I started in 2016. We are in 2020, so going on 15 years now, 14 years, excuse me. One of the things I discovered is that there are 3 areas that traders need to focus on to be successful. The first is when. So this is where I was talking earlier about there are different types of market situations. If the last couple of months has taught us anything, that not all markets are the same. You know, we would of course all love just a continuous trending market, not a lot of volatility. That would be ideal. That's not the case. There are markets that behave differently. So here is where we're going to talk about how to recognize each market, and more importantly, then you'll understand which indicator to use. And granted, there will be special situations and times where you might mix and match. You know, we're going to talk about the main ones today, and you need to know what types of markets there are, how to identify each market so you know which indicator to use. Once you get good at that, second is what are the indicators? Granted, again, there are dozens and dozens. But if you can focus on a few at first, it's going to help you tremendously. And then finally, how? How am I going to find my trades? If I understand what the market's doing, if I apply the ideal or the appropriate technical indicator to that market environment, how am I going to find trades? How am I going to find my trades? Now, there's the one-by-one method. That's where you look at chart after chart, trying to find setups. There are some faster ways as well. You know, with so many people doing shorter term trading nowadays, really, I think last 5 years or so, it's important to be able to find your trades quickly. The first thing you need to understand is when to use the indicators. There are three main types of market situations that we need to talk about. The market can do one of three things. It can trend. Great environment, right? Just very smooth, not a ton of volatility. Everybody's making money. Traders are making money. Investors are making money. That's ideal. Markets hitting higher highs, higher lows. You're in a nice uptrending environment. Then the market enters into a situation where it no longer trends higher. It enters into what's called a trader's market. Now, this is a channeling market. The market no longer hits higher highs, but it also doesn't hit lower lows. Now, this type of market is really difficult for an investor, right? The average investor who's just buying good quality stocks, but the market's not going anywhere, neither are those stocks likely, right? And then there are situations like recently where the market hits extremely oversold situations, all right, extremely oversold situations. So this is what a trending market looks like. Now, for those of you that are not familiar with VectorVest, what we're looking at here are candlesticks. Obviously, those are candlestick price bars, but that is what's called the VectorVest composite. We track in our program about 8,000 stocks. We use that 8,000 stock average as our broad market index. You can think of it similar to the S&P or the Dow or the NASDAQ, but this, what we're looking at here, the VectorVest composite, also known as the VVC, it tracks all of those markets, all of those indices into one. And this is the foundation. This is the basis of our market analysis. Okay, so this is basically in 2017, and this is an uptrending market. Market hits higher highs, higher lows, not a ton of volatility. What our jobs are, what we want to do is we want to be bullish only. In an uptrending market, we want to be bullish as much as we can. We want to buy stocks or we want to add to our long positions after each subsequent higher low. We don't want to become bearish in an uptrending market. What I mean by that is we don't want to look to short stocks, you know, after each higher high. Because
hey, Jerry,
those, yes.
Jerry, sorry to interrupt real quick. It looks like your slides aren't advancing. There you go.
Oh my goodness, there we go. Okay.
Thanks.
Fantastic. Okay. We don't want to be bearish after each subsequent higher high. Why? Because we're in an uptrend. Those pullbacks are generally shorter lived. Okay. So we want to be bullish only. We want to get defensive after each higher high. And we want to add to our long positions after each higher low. So that's a trending market. We want to be bullish only in a trending market. Now, so 2017 is over. This is 2018. Same VectorVest composite. The market is no longer trending. How do I know that? Well, here was the high back in January of 2018. Market sold off sharply, rallied, but that rally failed to make a new high. After the pullback, uptrend is over, right? After the pullback, uptrend is over. Now, are we heading towards a downtrend? We would have been if this pullback here in April would have winded up going lower than the February low. That would have been a downtrend, but it didn't. It stopped right at the same level, rallied a little bit. Now we're entering into a trader's market. So a trending market, I think it's easy to identify, right? You have a series of higher highs and higher lows. Once you no longer see a series of higher highs and higher lows, and you start to move into this sideways market, no longer hitting higher highs, but not hitting lower lows, you're in a channeling market, okay? Also known as a trader's market, okay? Failing to make higher highs, failing to make lower lows. This was actually what's called a descending triangle. You have a level of support here with a series of lower highs, nice breakout above that downtrend line happened in the middle of May, but we broke out of that triangle, but we never resumed the uptrend that we saw, in 2017. Again, failing to make a new high. What we're seeing is just a bouncing back and forth between support and resistance. I said earlier, this is really difficult for an investor, but traders welcome it. They'll be bullish at support, they'll be bearish at resistance, they'll play the market back and forth as it develops. Then finally, the third type of market that we're going to see is when the market hits an extremely oversold situation, similar to what happened back in 2018. So VectorVest composite here we see it again, sold off sharply at the end of 2018, bottomed out December 24th, and within our VectorVest tool, we have two market analysis indicators that help us identify bottoms, or at least get us ready to search for a bottom. Those two indicators are the MTI, stands for the Market Timing Indicator, and the Buy to Sell Ratio, okay, BSR. When the MTI goes below a level of 0.60, when the Buy to Sell Ratio goes below a level of 0.20, we start to search for a bottom. And the reason why we do that is because historically, when we've seen those indicators get to those levels, we were somewhere near a bottom. Now we don't just load up the truck and start buying stocks again. Let me just make sure you guys can see my mouse. We don't just load up the truck and start buying stocks again just because those indicators get to those levels. We wait for a rally, or we wait for that explosive rally that generally does occur off of major market bottoms. And that rally happened the day after Christmas, Santa Claus rally, big green candle there. This is again the VectorVest composite. That big green candle formed a bullish reversal pattern called a one white soldier. Followed through the next day, and there we were off of the bottom, getting ready to buy stocks again. But those indicators really give us an advantage on being at the right place at the right time, being aware that upside potential, when those indicators get to those levels, it outweighs further downside risk. So we start to get ready to buy stocks, we wait for that rally, and that's what happened at the end of 2018. So that's how you identify in our view, the three different types of markets that you'll see. You'll see a trending market, similar to what we saw in 2017. Market will no longer trend anymore, okay? It'll move sideways, it'll channel. It won't hit higher highs, but it won't hit lower lows, so you're in a channeling market. And then finally, when that MTI indicator, when that buy to sell ratio indicator gets to those levels, we're in an extremely oversold situation. Knowing that, now we have to say, okay, which indicator should I use, or which indicator is ideally suited for each market? In a trending market, we're going to talk about the MACD. Okay, MACD stands for Moving Average Convergence Divergence. The first two words in that indicator are moving average. If you know anything about technical analysis, you know that moving averages are trend indicators. So it just makes sense to us. Hey, if you're in a trending market, it just makes sense to use a trend-based stock selection indicator, okay? MACD identifies meaningful changes in trend, all right? If you're no longer in a trending market, and we saw what that market with a channeling market looks like, what a trader's market looks like, basically just moving sideways, bouncing back and forth between support and resistance. If you've ever tried to apply the MACD or use the MACD in a channeling market, you know that you don't have much success, right? If moving averages don't work well in a non-trending market, so MACD won't work well in a non-trending market. It's ideally suited for a trending environment. Now, support and resistance is a great indicator to use in that channeling market. So for example, if the market is retracing from support, let's say we have a significant support level with a couple of retests, couple of touches at that level, you got another retest of that support level with a retracement. Let's go find stocks that are also retracing from their own support levels. If the market's pulling back off resistance, let's go find stocks that are pulling off of their own resistance levels. And then finally, stochastics. This is probably my favorite indicator. I love stochastics. I use stochastics with bullish and bearish candlestick reversal patterns. But when the market hits an extremely oversold price situation, stochastics is a great indicator to use because it too identifies overbought and oversold situations. So really quick, the MACD, I'm not going to get caught up in or teach you guys at all about the formula of the MACD, how it's calculated. If you want to Google MACD, you'll get all you need to know about how the indicator is calculated and what the formula is. We're going to talk about how to use the indicator. So here we're looking at Netflix, really simple way to use the MACD. I've added it to the bottom of the chart. When the histogram bars go positive, when the yellow bars go from below 0 to above 0, that's bullish. That's a buying indication. Okay, and as you can see, in an uptrending market, okay, it gives us more positive signals than it will give us failing signals. Okay, not every trade that you place using a bullish MACD crossover in an uptrending stock is going to be a winner. We know that. But what we're trying to do, remember earlier I said we're trying to put probability on our side. So using a trend-based stock selection indicator in a trending environment, whether it's an uptrending market, an uptrending stock, will result in more winning trades than losing trades. In this example here that I'm showing you here, you might have walked away even, right? October 5th, 2017, you had a bullish MACD crossover. You're still in an uptrend, higher highs, higher lows. You enter the trade off of that signal, and you got a bearish signal about a week and a half, maybe 2 weeks later. You walked away even, maybe a small little loss. Okay, but you're following your rules, because if you don't follow your rules and you say, you know what, I'm not going to get out here. I'm not going to get out here. Why? Because we're in a nice uptrend. The stock is going to continue to go up, right? If you say that to yourself, what happens? Well, you wind up staying in a position that you shouldn't, only to watch that small little loser that you could have cut early with the signal turn into a much bigger loser. I heard Dr. Alexander Elder earlier say, you're asking yourself, what do I do now? Right? That's the worst question you can ask yourself when it comes to trading. What do I do? What do I do now? Right? You have to have a plan in place, and just simply using the MACD to enter and exit trades is a system, is a plan. And you wind up taking a small little loss, better off turning that small into a loss into a bigger loser. You know you can get back in. There's always going to be another opportunity. Okay, always going to be another opportunity. So here's another example where you're in a nice uptrend. Okay, got a nice pullback here off of a new high. Now the MACD, guys, it's a lagging indicator. It's a trend indicator, right? Trend analysis and moving average crossovers, those are lagging indications. It's going to take a meaningful change in price direction to give a signal. So here, we're a couple of weeks off of that low, off of that swing low. So we got in a little late. We're trying to get a bigger piece of the move, and this one winded up, we got a bearish MACD crossover here, small little loser, knowing very well we can always get back in. Okay, now I want to show you something here because this is really important. Now we're in August of 2016, and the uptrend is over. How do I know that? Well, it was still intact here in May and June of 2018. June of 2018, new high. Got a pullback, rally, higher low, nice series of higher lows, but that rally at the end of June failed to make a new high. Pullback, uptrend over. All right, now you're in a downtrend or a sideways market. Watch how many signals now produce losing trades. So now we're not in an uptrend anymore. So if you continue to use the MACD in a bullish way, where you're buying with every MACD bullish crossover, it's going to result in more losing trades than winning trades. Now you can short the stock fine after each bearish crossover in a downtrending market, but don't try to buy the dips. Don't try to buy thinking that that's going to be the one, that's going to be the bottom, and you're going to buy, and then the stock's going to continue just to scream upwards. Okay. So just to recap there, trending market. First, identify what the market's doing. If it's trending, if you see the market, and you can use the S&P, the Dow, whatever broad market index you track, we use the VectorVest composite. If it's hitting higher highs and higher lows, you apply the MACD to a stock that's doing the same thing. You're gonna have more winning trades than losing trades. If the market no longer hits higher highs and it starts to channel, let's talk about support and resistance. Another very popular trading technique is just to use support and resistance levels. One of the great things about the VectorVest tool is it has a way to automatically draw the support and resistance lines for you on the chart. You can draw your own. I like to draw my own as well, but our system, our graphing package has a way to automatically draw those lines for you. So let's take a look at what I'm talking about. Before we get too deep, what is support and resistance? Basically, support is the floor. It's a level. It's a level where stock prices have stopped going down and begin to go back up. Now, that typically happens on multiple occasions. It's where demand is deemed strong enough to push the price higher to support it from falling any further. Resistance is the ceiling. It's a point where stock prices have stopped going up and they begin to come back down, again, typically multiple times. It's where supply is deemed strong enough to push the price lower, to resist it from rising any further. And support and resistance is the ultimate crowd mentality indicator. I want you guys to think of it in terms of this. You bought a stock, right? You watch it go up. It keeps going up. But you don't sell it. Why don't you sell it? Because you think it's going to continue to go up. And then what happens? It comes crashing down. And what do you say to yourself? You say, okay, well, I weathered the storm, right? I gave back a lot of gain, but if it ever gets back up to that level again, I will get rid of it this time. Then what happens? Price eventually gets back up to that level again. You and everybody else who bought it back here, you sell it. What does that do? Puts tremendous pressure on the stock's price, and it will begin to fall. So how do you use support and resistance in your trading? Number one, if you see price hitting support and bouncing off of it, that's bullish, okay? Typically, price is going to continue to rise until it reaches the next support, resistance level. So when price bounces off support, that's a buying opportunity. Buying opportunity number two is when price breaks out through resistance. Remember, we already said that there was that built-in selling pressure, right, around those resistance zones based on the crowd mentality. If a stock's price is able to overcome that selling pressure and bust through that level, that's very bullish, and that would indicate a buying opportunity. Second, you can also use support and resistance to indicate when to sell a long position or to initiate a short position. So bearish situation number one is if you see price hitting resistance and moving back down, that's bearish. Hitting resistance and moving back down. Typically, price is going to continue to go down until it reaches the next support level. So if it's a trade that you're in and you see price retracing from resistance, you should consider selling it or taking other defensive actions. If you don't own the stock, that would indicate a shorting opportunity when price retraces from resistance. Additionally, if you see price breaking down through support and moving lower, that's bearish as well. So if you're long the trade and price breaks down through support, might want to cut your losses, move on and take your money off the table. If you're not long the trade, that could indicate a shorting opportunity, okay? Finally, another indicator that we're going to talk about is stochastics. As with other oscillators, it helps pinpoint overbought or oversold price situations, okay? Overbought or oversold price situations. Don't let all the squiggly lines confuse you. It's not confusing. Again, if you want to Google stochastics, you'll see what all you need to know about how the indicator is calculated. It's a very tedious calculation. I'm just going to show you guys how to use the indicator, and we're going to take a closer look at an example here. Okay. On the lower end of the indicator, now the indicator oscillates between 0 and 100. Below 20 is oversold, above 80 is overbought. I'm just going to talk about the oversold situations or the buying opportunities here today. Now, would you agree when the stochastics oscillator goes below 20 that you're somewhere near a buying opportunity, right? Somewhere near a buying opportunity. Now, you're not at the exact bottom, but you're near a buying opportunity. And by the way, Abbott Labs is trending, right? The stock is trending higher. Even though you may look at these little pullbacks here and you're like, wait a minute, that's not oversold, right? This pullback isn't oversold. This pullback isn't oversold. We're in an uptrend. How can that be oversold? Earlier, I said that it's really difficult to make sense of just price alone. That's what indicators are for. So even though you think that this pullback here or this pullback here doesn't constitute an oversold situation, Stochastic is telling us that it does, okay? Now, a buying opportunity occurs when the stochastics oscillator moves from below 20 to above 20, not just when it goes below 20, when it goes from below 20 to above 20. So as you can see, good example here, stochastics goes from below 20 to above 20, below 20 to above 20, good opportunity to get in. And now what are we seeing here that's a little different than the MACD, right? The MACD probably would have gotten us in maybe a few days or so after the stochastics gave us a signal, because stochastics in the way we're using it isn't a trend signal. It's a signal identifying when a stock leaves an oversold situation and begins to move higher, okay? Not a trend change. That's what the MACD does. So it's a little bit different in what it is designed for. A couple of days off of the bottom. Just a couple of days off of the bottom, okay? So let me take you through a little example here. February 13th, 2018. New high, sharp pullback. That new high there, boy, if I was long that trade, I would have been concerned by those candlestick patterns. This one right here is called a shooting star. That's a bearish candlestick formation followed by a doji. The reason why I'm concerned with that behavior is that in an uptrend, when you see those long upper wicks, we're looking at daily bars, by the way, not weekly bars or intraday, we're looking at daily bars. When you see those long upper wicks in an uptrend, you got to be very, very careful if you're long the trade. We saw weakness on the following days. Good opportunity to get out. You get out, you get yourself an opportunity to get back in at a lower price. Stochastics goes below 20. Not only that, and I talked earlier about how I use stochastics. I use stochastics with bullish and bearish candlestick formations. So a few days earlier, before my date line here, we had what's called a bullish harami. That's a bullish reversal pattern. Stochastics below 20. Follow through the next day. Stochastics crosses from below 20 to above 20. Good buying opportunity there. Really nice reversal pattern there. Okay. Remember that earlier, that level I talked about earlier, where weakness really showed itself in terms of the bulls, right? They lost control, right? Bears came in on each of those days. They pushed the price well off of the highs of the session. We saw weakness. That level is where I'm going to pay very close attention to. Stock reaches that level again in March of 2018. It doesn't break out above it. I would have loved to have seen it break out above it, but it didn't. It stopped right at it and then pulled back. What is that level now called? That's called resistance, isn't it, right? So if price reaches the same level twice and fails to move higher, it establishes resistance. Good opportunity to take your gain off the table when price failed to make a new high. Buying low, selling high, always knowing that you're going to be able to get back in. Why are we getting back in here? Because stochastics went below 20, crossed above 20. Where did the stock stop going down? It stopped going down essentially at the same level that it stopped going back down here in February. So we enter off of a stochastics crossing above 20. We say that doji on the following day. We're in the trade, okay? That's also now a support retracement. isn't it? So you have price reaching a support level, retracing from it, you enter, because we know that's bullish. You also have stochastics crossing from below 20 to above 20. Then what happens the day after you enter the trade? The stock crashes, doesn't it? Big red candle here, and what do you say? You're saying, oh man, doesn't this always happen to me? I buy a stock, it goes down the next day. It does happen sometimes, but now what I want you guys to understand is hopefully you're better equipped at managing the trade better, because maybe in the past you would have sold it. You would have panic sold it. You said, my goodness, I don't want to take a big loss. That's a big down day, boy. Boy, that's a big down day. But now you know where you entered. You entered off of a support level. So what did we say about what to do with a long position when or if a stock's price, the price when you're in the trade breaks down through support? We said to get rid of it, right? Well, it doesn't break down through support. It stops again at it. So it's establishing a very significant resistance level here. You're better equipped to say, you know what? I know the stock went down that, big that day. I have a level here that I know is going to protect me from future losses. I'm going to hold that level. I'm going to use that level to stay in the trade. The stock then rallies. It retraces off of support again, and you're thanking yourself, patting yourself on the back for making the right decision. Then what happens? We got another pullback. We got another retest of that support level. In the past, you may have panic sold and said, I'm just going to get out. The stock's not really doing anything. And that's understandable. But if you have a level of support here, remember, that's what it's called, support, for a reason, because it supports the stock from falling further. You understand that level, and you're using that level to help you manage the trade. You get a pullback, another retest of that level. See that long lower wick? Long lower wicks at support, that's bullish, okay? That's called a hammer. That's another bullish pattern. So you stayed in the trade, you were able to withstand the pullback, price stopped at support, retrace from it, you're in the clear, now you're profitable. Remember that resistance level that we said was established right here at about $64. Well, it doesn't just go away. We're going to use that level. I hope that if I'm in this trade, if I was able to stay in long enough to be profitable, I'm going to pay very close attention to when price reaches that resistance level again. It stops at it and pulls back from it, I'm taking my gain off the table. I would have loved to have seen it break above, but it didn't. You're always be able to get back in at a better price. So price pulls back, stochastics goes from below 20 to above 20, you buy back. Resistance doesn't disappear, it's still there. So price rallies. See that big red candle? I'm going to tell you guys that I would have exited the trade. I'm going to exit the trade. Why? Because that is a clear retracement off of resistance, which we know now is bearish. If you're long a trade and price breaks down through resistance, breaks down off resistance, exit the trade and move on. I know what price did afterwards. The stock price rallied and broke out above resistance. That's okay. After it broke out above resistance, it came back down to retest that level again, which is now support. Rally, another retest of support. That retest of support also coincided with stochastics going from below 20 to above 20, another signal, another entry. Okay. Here we would have lost. All right, we would have lost on this trade. Now we're back into an uptrending environment, aren't we? Right? We weren't back here, on the left side of the page, and back further when we saw Abbott Labs just kind of going back and forth between support and resistance. We were in that trading market or that channeling market. Now we're back into an uptrending environment. You got a new high, you got a pullback. Here's your higher low. We enter off of that higher low, off of that higher swing low. Stochastics goes from above 20, from below 20 to above 20. We buy on that follow through day, only to see the stock fall the next couple of days. What do? Well, we're now in an uptrending environment, right? So that higher swing low is going to be my initial stop loss, right? Because if you're in an uptrend, just draw a line, and then that uptrend is broken, might be a good idea to exit the trade. So you walk away with a small little loser. You're always able to get back in at a better price. If stock price continues to go down, Stochastics, as we see, went back below 20. Crossed from below 20 to above 20, gives us another buying opportunity. Okay? So the most recent high there is my initial profit target. Stock barely reaches that level and breaks down through it. Good opportunity to take your gain. Now we're back into that sideways market, aren't we? Right? We're back into that sideways market. We're not trending anymore. So here, another example, December 27, 2018. We enter off of a couple of signals, right? Because Stochastics goes from below 20 to above 20. And the stock's price also retraces from a level at which it retraced from twice before. That is support, right? If the stock went all the way down here, if price came all the way down here, right, it would have blown past that support level. It didn't. It stopped at it and then retraced from it. So we take the trade. We're in it 2 days and the stock crashes again for a couple of days. Again, I hope you guys are better now at managing the trades, because now you see a very significant support level. 1 touch, 2 touches, 3 touches in that support zone. If you get a blow pass through it, okay, you're out. But now we have a 4th successful retest. You're in the trade, price goes down a couple days, you got a 4th successful retest, and you're able to stay in. All right, so that's the 2 pieces of the triangle, right? When to use certain indicators. The market's going to either trend, it's going to move sideways, or it's going to hit an extremely oversold situation. Recognize that. Recognize what the market's doing. And I taught you 3 indicators to use in each of those market situations. And there are situations where you can mix and match. Let me just say this though. Don't use the MACD in a sideways channeling market. Don't use the MACD in an oversold market situation, okay? But you can use support and resistance and stochastics really in any market, okay? I just want to make it simple for you guys to say, okay, if the market's doing this, here is the ideal indicator to use, not to say that you can't use stochastics in an uptrending market. You can, okay? But just don't, and really don't use the MACD in any other market other than a trending market. If you do some testing on it and you apply the MACD to a channeling market, you'll see that it's going to give you losing signals more times than it gives you winning signals. Okay. Now, the third piece is how are we going to find our trades? There are 3 methods. There's the 1-by-1 method. This is where you look at chart after chart after chart. So for example, if we are in a trending market, right? You're looking at the market hitting higher highs and higher lows, and you want to say, you know what, I want to find stocks whose MACD first crossed bullish today. You got to look at the charts. You got to go through chart after chart. If the stock that you're looking at MACD didn't cross today, you move on. Not a week ago. We don't want a MACD to cross a week ago. We want the crossover to occur the day that we're looking at it, as of the hard right edge. You can imagine how much time that's going to take. 1 by 1 by 1. You can look at every stock in the S&P 500 and maybe you won't find one. That's unlikely, but it's possible. The next method is to use a scan. This is one of my preferred methods because it just, it filters through the S&P 500, for example, and it finds stocks whose MACD just crossed bullish today, or whose price, any stock in the S&P 500 whose price is retracing from support. Okay. Then finally, there is a tool that we have within the program, in the VectorVest program, that gives you automatic alerts. Okay, so just quickly using the one-by-one method, you're going to go through the charts. Here we're looking at a list of the S&P 500. You go through the charts, you look for a MACD crossover today. You don't find it, you move on to the next stock. Keep doing that till you find a handful of viable candidates. Then there's using a scan, and within the VectorVest real-time program, we have a tool built in called Pro Trader. It's a technical analysis scanning tool. It allows you to scan for MACD crossovers, stochastics crossovers, all four support and resistance situations that I talked about. Price breaking support, breaking resistance, retracing from support, or retracing from resistance, just depending on what the market's doing. Then we have a tool called the Watchdog. All right, the Watchdog is a real-time alert system. So the second method, the method I just showed you there using Pro Trader, where you have to run a scan, you do have to click a few buttons daily. You know, every day you want to run a scan, you got to click a few buttons to find stocks that, for example, have a MACD crossover today. With the Watchdog, you set it up once and it alerts you during the day when any stock, I have a few running most days. I'm looking at bullish MACD crossover on the S&P 500, for example, okay? During the day, you see some of these these times here, and I have after hours, I look after hours as well, but it gives me alerts, sends me a text message and an email when any stock in the S&P 500 during a given trading session has a MACD crossover, for example, if I'm bullish on the market. If I'm bearish on the market, I'd set up a bearish MACD crossover, or I'd set up a watchdog for stocks retracing from resistance, right? The point what I'm trying to make is pay attention to what the market's doing. It's going to help your trading approach moving forward. All right, so you showed up today. I'm going to venture a few guesses. You maybe feel like you're missing out on the current market. There's money to be made in this market. All right, the market it's almost halfway back to the all-time highs, believe it or not. I know it doesn't feel that way, but we're almost 30% off of the bottom. Okay, if you calculate the S&P from the bottom till now, you're looking at a 30% move off of the bottom. And we're just about halfway to the all-time highs again. So hopefully you guys are taking advantage of this market, but maybe you're here today because you're not. You feel like you're missing out. Maybe the trading plan that you're using isn't performing like you want it to, or you're tired of going through one chart after one chart after one chart. You want a better, faster way to find trades. So you learned today to match the indicator to the market. Okay, if you take anything away from today is pay attention to what the market's doing. I don't know if you've heard this before, right? If the market's going up, the S&P is going up, 80% of the stocks are going up. If the market's going down, 80% of the stocks are going down. So it increases your odds and increases your probability of making money if you follow what the market's doing. If the market's going up, if it's trending, use the MACD. It's a good indicator to identify changes in trend. If the market's moving sideways and let's say it's retracing from support, find stocks that are retracing from support. You also learned how to effectively use popular technical indicators. And then finally, there are quicker and easier ways to find trades. You don't have to look at charts. I don't mind looking at charts. I love looking at charts actually. But there are times where I just want to make that process a little easier. I'll run a scan first, then look at the charts instead of just going about it, from scratch essentially. Big lesson: technical analysis can help anticipate future direction. Right? I didn't say it can help predict future direction. That's not what it does. It helps us anticipate future direction, and you can find some great trading opportunities, especially if you use the power of speed and scans and alerting systems. You may be asking, okay, this is good stuff. How can I get started using this stuff now? You have a choice. You can do it the slow way, the one-by-one method, take bits and pieces of what I taught you today, or the fast way, okay? Within the VectorVest real-time program, we have fundamental and technical charting. Okay, you can look at every stock in our database. You can apply the MACD to the chart. You can apply support and resistance. You can apply stochastics. You would look for crossovers or retracements, just depending on which indicator you're using, and you'd go through the one-by-one method, right? Within the VectorVest real-time program as well, we have those searches. We have an easier way to do it. You can scan for crossovers. We have the Watchdog tool, which sends you real-time automatic alerts. Okay, so what I want to show you guys here today is what's called the VectorVest real-time program. Provides fundamental and technical charting. We provide you guys with market timing signals for clear entries, pro trader searches, that's those technical searches, the Watchdog, which gives you instant alerts. We have a tool called the Genius. It's an automated portfolio manager. Great tool to help you keep track of your portfolio. Also gives you alerts as well. We have pre-built trading systems, and of course, real-time streaming data. Now, we would normally sell all these tools, this whole package, for $137 per month. What I want to do, guys, is I want to give you an opportunity to try it out just for $10. We're offering special for MoneyShow attendees, a $9.95 trial. It's good for 30 days. You can go to that website that you see at the bottom there, vectorvest.com/capture. Mark, if you don't mind, could you actually type that address in the chat box so people can see it and that they can click on it?
Yeah, absolutely. I'll do that right now.
Thank you very much. All right. And also, this is also special for those folks that do sign up for the trial. Again, $9.95 for 30 days. We're going to send you a stock buying checklist. This is great for those of you that like to be a little bit more hands-on with your trades. If you did listen to Dr. Alexander Elder earlier, he talked about keeping records of the stocks that you buy. Why did you buy them? Why did you sell them? When did you buy them? And this checklist here really helps to follow all the rules that we discussed today. What's the market doing? Check the box. Is it trending? Is it trading? Is it moving oversold? Which indicator am I using? Do I have a bullish signal? So it really helps to keep track of your trades. This is also money back guaranteed. If at the end of 30 days you say, you know what, thank you, but I'd like my $9.95 back, we'll give you the $9.95 back, no questions asked. Okay. So I want to thank everybody. I know I'm a little early here, but I just want to thank everybody for joining me here today. This trial here is good until I believe Tuesday of next week. So if you have any questions, you can visit our website. It's vectorvest.com. Okay, vectorvest.com. Now you want to go to that website that you see at the bottom there to order the trial. It's 30 days, $9.95. This is a very, very special offer because we wanted to give you guys an opportunity to try out the VectorVest real-time program if you don't already have it. But if you do have questions, you can go to our website and our phone number, our support number is right at the top of our website, and just give our support department a call if you guys do have any questions about anything. So I want to thank you guys for joining me here today. Stay safe and healthy. I want to thank the Money Show as well for having us. We'd love to be here again. So thanks again, Mark.
All right, Jerry, thank you so much. Hey, there is a little bit of time remaining. I don't know if you wanted to take a few questions or if not.
I do. I would love to. Yeah. Where can I see them?
Let me elevate you. I can elevate you so you can see them, or
Okay.
I can relay them to you, whichever
you can relay them to me. Yeah, sure. I could take a couple.
Okay, sure. Let's see. All right, we did have a question come in. They're wondering if the MACD indicator would work equally as well on stocks, indices, oil, and gold.
Yes, it does. It's a price indicator, right? So it's a price trend indicator. It's not specific to just stock prices. It's a price indicator because it's based on moving averages. So moving average analysis works on any price instrument, ETFs, stocks, indices, absolutely.
All right, another question here. They're asking if VectorVest offers training classes with the program.
We do. We have free webinars throughout the week. We have paid courses as well. Now we have paid courses that cover options, retirement, swing trading, just kind of basic investing courses as well. So a lot of our courses are paid courses. but a lot of our webinars are free webinars on a weekly basis. So we have plenty of training. We have recorded videos within the software. We have free product support as well. So if you did take out the trial, what's going to happen is you're going to get a kind of a one-on-one initial coaching session. The rep, the consultant, will direct you to videos that you can watch, the free videos that are online. And then if you have any questions after you watch those videos, you can, of course, give us a call.
All right, excellent. Thank you for that. Another question here, they're wondering about an options trade scanner. Is there one out there? We
don't have one within the VectorVest real-time program. We have an add-on module called Options Pro. It's an additional fee. It's an additional add-on to the VectorVest program. That is an option scanning tool. So it's not part of the package that you see here, guys, but if you took out the trial to the VectorVest real-time program and say, you know what, I've heard about this Option Pro tool, you could take out a trial to that as well. So it's not part of the real-time program, but it is an add-on, but it is an option a scanning tool.
All right. Another question there in reference to the MTI and BSR, they're wondering if they could find that on other various charting platforms.
Good question. No, those are native to the VectorVest. Those are proprietary VectorVest indicators. So they're not found anywhere else. Essentially what the buy to sell ratio is, we track 8,000 plus stocks. We give a buy, sell, or hold rating for every stock every day. So we really pay attention to that ratio of how many stocks are getting buy ratings compared to how many stocks are getting sell ratings. And we have an indicator called the buy to sell ratio. The MTI identifies what the underlying market trend is. MTI above 1, underlying trend is up. MTI below 1, underlying trend is down, and it's on a 0 to 2 scale. So very unique indicators native to the VectorVest program.
All right, and do those trades have to be made through VectorVest?
So we are not a brokerage. We are a research and analysis platform. We are currently partnered up with Ally Financial, TradeStation, and Interactive Brokers, which means if you have an account with either of those, you can link your account to VectorVest and then trade through the VectorVest system, through the VectorVest program. Otherwise, you would have to have, let's say you have an account with Schwab, you'd have to have your Schwab account open, you have the VectorVest program open, you do your research and stock selection within VectorVest, but the trade would have to be placed with Schwab. But again, if you have an Ally, TradeStation, or Interactive Brokers account, we are partnered with them. We are API linked with them, so you can trade directly through the VectorVest program if you have an account with any of those three.
All right, excellent, thank you. They were asking on a personal level, do you have a specific book on trading psychology that you recommend or that you've read?
I like trading for a living. I really wanted to get in earlier today because I love Dr. Alexander Elder. That's one of my favorite trading psychology books, Trading for a Living. I haven't written one, but in terms of books that I've read, it's my favorite trading psychology book.
All right, excellent. A question they were wondering, does VectorVest have a trading journal functionality to measure performance?
We have, within that Genius tool, we have a trade history. So for example, if I go to reports here and go to trade history, this is just a portfolio that I have running, you can view a trade history. So you don't have to keep track on paper. It gives you really a lot of good information. The symbol, whether you were long or short, the day and time that you opened the trade, the day and time that you closed the trade, what your net gain or loss was, the percentage gain loss, what your initial price was, the final price, how many shares you bought, your initial cost, and then your final cost. So within the program, we have a trade history function that allows you to see all of the information for the trades that you place.
All right, perfect. And along those lines, does VectorVest, do they follow all stocks and all markets?
We have different databases. So within the VectorVest US program, we have 8,000, and let me just see here. We track 8,176 stocks within the VectorVest US program. We have a VectorVest Canada program. We track, I think, over between about 3,000 stocks. VectorVest Europe, UK, Australia, Singapore, and Hong Kong, and we track a lot of stocks in those markets. So about 8,200 stocks in the US, and and different stocks across different markets. So again, VectorVest US, Canada, Europe, UK, Australia, Singapore, and Hong Kong.
All right, perfect. Just a little bit of time here remaining. They're wondering, how does the VectorVest program deal with extreme volatility?
Good question. How does the VectorVest program deal with extreme volatility? Well, what we do is we track the market. That's kind of one of the best and most important things that we do. And in our color guard here, this color guard, I don't want to get too deep into it. The color guard represents market direction, the market environment. A lot of green is good. If you see green across the board and all of the indicators, that's good. Market's going up, not a lot of volatility. If you see a lot of red, means the market's going down. If you see what we're seeing here, where you have all three colors mixed in at the same time over the last 3 weeks, that does indicate some market volatility. This trend indicator here, where it's going up and down, up and down, up and down, very, very, quickly over this course of this period, that's another indication of a volatile, non-trending market. We analyze the market. Is it going up? Is it moving sideways? Is it going down? We relay that information to you. Then we track 8,200 stocks, and we provide fundamental and technical analysis on all those stocks. So we are research, we are analysis, and that color guard is going to help you a little bit to identify whether the market's trending nicely or a little bit more of a volatile environment.
Perfect. Another question came in. They're wondering if they have a $20,000 trading account, would it be reasonable to think you could make enough each month to cover the monthly cost?
Absolutely. So the annual subscription to the program is about $1,000 a year. So a $20,000 account, we're looking at 5%. So if you make any more than 5% a year using our program, you're paying for the cost of the program. So without a doubt, 20%, $20,000 is more than enough. You take $1,000 out of that, that's 5%. You can make up 5% very, very quickly.
Definitely does sound very reasonable.
Oh yeah.
They're wondering, what factors does VectorVest take into account to calculate that buy and sell ratio?
Sure. It's very detailed, so not going to make much sense to you, but I'll let you guys know. For a stock to get a buy rating, has to be above our stop price. Our stop price is a 13-week adjusted moving average. So for a stock to get a buy rating, it has to be above our stop price. And two of our core proprietary stock analysis indicators have to be above the value of 1 on a 0 to 2 scale. The stock's price also has to be diverging away from that stop price. So those are 4 rules: price above the stop price, price diverging away from the stop price, and 2 of our core analysis indicators have to be above 1. All 4 of those rules are met, stock gets a buy rating. For a stock to get a sell rating, it's simple. Price is below our stop price, our 13-week moving average. So if price crosses below the stop price, it gets a sell rating. So for a stock to get a buy rating, it's got to be in an uptrend. For a stock to get a sell rating, it's in a downtrend. And we really, again, pay very close attention to the relationship of stocks in uptrends compared to stocks in downtrends. That's that buy-sell ratio. It's a really important market analysis indicator in the program.
All right, perfect. Looks like we have time for one last question.
Okay.
They were just wondering about the So if they sign up and if it's just not right for them, is there a cancellation policy?
Yeah, it's no questions asked. If at the end of 30 days you want to cancel, we will do that. We will give you your $9.95 back. You just have to give us a call or shoot us an email. Very, very simple way to cancel. Give us a call, shoot us an email, say I want to cancel my trial, and we'll refund you the $9.95.